Okay, today we're going to go over the mortgage contingency portion of the agreement of sale, and it starts with paragraph 8, okay? Buyer's financing. You can all see my screen, right? The shared screen.
Right.
Okay. So you have to remember this agreement of sale is outlined for a reason. It's in an outline format, okay? And everything's placed for a reason and bolded for a reason or boxed in for a reason. Okay. So it usually shows the importance of that sentence or that portion of the contract. Okay. So we start off with number 8 here, buyer financing on line number, what is that, 91. And then right immediately below it is subparagraph A. Okay. And it states here, buyer may elect to make this agreement contingent upon obtaining mortgage financing. Regardless of any contingency elected in this agreement, if buyer chooses to obtain mortgage financing, the following apply. So what this is stating is this is a preface to the actual contingency, because remember, we haven't waived or elected anything yet. This is just saying if you're going to get a mortgage, these 4 steps have to follow. Okay, they can't be ignored. So 1 is buyer will be in default of this agreement if buyer furnishes false information to anyone concerning buyer's financial and or employment status, fails to cooperate in good faith with processing the mortgage loan application, including payment for and ordering of appraisal without delay, fails to lock in interest rate as stated below, or otherwise causes the lender to reject or refuse to approve or issue a mortgage loan. Okay, so 1 is warning the buyer to not lie and just act in good faith and move along with the mortgage process. Okay, that's 1. 2, within blank days, 7 if not specified, from the execution date of this agreement, buyer will make a completed mortgage application, including payment for and ordering of credit reports without delay for the mortgage terms and to the mortgage lender identified in paragraph 8F. That's the box, okay? If any, otherwise to a responsible mortgage lender of buyer's choice. So technically, you could leave the mortgage lender's name blank, which some buyer agents do because their buyer hasn't picked anybody yet or locked in. But it's just stating that within 7 days, you better pick that person and make application. Okay. Broker for buyer, if any, otherwise broker for seller, is authorized to communicate with the mortgage lender to assist in the mortgage loan process. Broker for seller, if any, list agent, is permitted to contact the mortgage lender at any time to determine the status of the mortgage loan application. Okay, so that's kind of saying, hey, you're allowed to, as a list agent, to check up on this mortgage. Okay, do your due diligence. So that's 2, make application in a timely manner. 3, seller will provide access to insurers' representatives and, as may be required by mortgage lenders, to surveyors, municipal officials, appraisers, and inspectors. So number 3, irregardless if the mortgage contingency is elected or not, if we're obtaining mortgage, the seller will allow access to the property so that whoever is given the mortgage or whatever is allowed into the property. Okay. We've had several instances where sellers are like a roadblock for this critical step. Like, no, I'm not letting an appraiser in. Well, we need to let an appraiser in so that you can appraise the house so we can get the loan. Okay. Number 4, if the mortgage lender gives the buyer the right to lock in interest rates at or below the maximum levels desired, buyer will do so at least 15 days before settlement. Okay, we'll do so at least 15 days before settlement. Now, that 15 days is written in. Did you notice that? It's written in already. It's not a blank. So if you negotiate and make that change, you can strike that out, okay? And probably my suggestion is a 30-day settlement, sure, that's okay. But if you have a 45 to 60-day settlement, you may want to push that number up higher, okay? For example, do so at least 30 days before settlement date on something that's supposed to settle in 60 days. So they're not waiting until the last minute to lock in the rate, right? So be very careful when you read these contracts. If you have, especially on the listing side, if the settlement date is so far out, you want to reflect that with locking in the rate. Okay. So we have subparagraph A, and now we move to subparagraph B, line 108. The loan to value ratio, LTV, is used by lenders as one tool to help assess their potential risk of a mortgage loan. A particular loan to value may be necessary to qualify for certain loans, or buyers might be required to pay additional fees if the loan to value exceeds a specific level. The appraised value of the property may be used by lenders to determine the maximum amount of a mortgage loan. The appraised value is determined by an independent appraiser subject to the mortgage lender's underwriter review and may be higher or lower than the purchase price and or market price of the property. So what's loan to value? Scroll down here to the attachment. Loan to value percentage. Loan is the amount bank is allowing you to borrow. Value in this case means the appraised value. Okay, so the loan to value is the amount bank is allowing you to borrow versus the appraised value. So for example, you have a $200,000 purchase price. 20% down is $40,000, right? Got that, Jim? Okay. So the loan then is 160,000, 80%. Okay, buyer will borrow 160,000. Buyer will need 40,000. So an 80% loan to value in this case is equivalent to saying $160,000 loan amount to a $200,000 purchase price. Okay, that's what it's saying. Now, what if the home only appraises at 190? Okay, so let's say the appraised value is 190. 20% of 190,000 is $38,000. Okay, that's what the buyer will need for their down payment, 38,000. The loan amount now is 190,000 minus 38,000, and you're left with 152,000. Okay, that's all the bank's willing to loan you, 152,000. So now the buyer will need to bring an additional 10,000 because that's the shortage, right? From 200 to 190. So now they'll need the 38,000. They're going to borrow the 152,000 plus another 10,000. And when you add up those three numbers, you get $200,000. So now the loan to value is now $152,000 loan amount to $200,000 purchase price. So now your loan to value is really 76%. Well, that's not what you wrote in the box. Okay, and we're going to go over that here when we get down there. Okay. Okay, so basically subparagraph B is just explaining loan to value, the meaning, the definition of it. Okay. Subparagraph C. Now, remember how I was talking about how things are designed in a way in this contract. If it's bolded, it's probably important. If it's boxed in, it's probably very important. So this FHA VA box is boxed in, okay, all by itself. Now, keep in mind, we still haven't elected yes or no to having a mortgage contingency or not, okay? This is still before that box. So C states that it is expressly agreed that notwithstanding any other provisions of this contract, okay, and I have it highlighted, buyer will not be obligated to complete the purchase of the property described herein or to incur any penalty by forfeiture of earnest money deposits or otherwise, unless buyer has been given, in accordance with HUD, FHA, or VA requirements, a written statement by Fair Housing, the VA, or direct endorsement lender setting forth the appraised value of the property of not less than blank, the purchase price as stated in this agreement. Buyer will have the privilege and option of proceeding with consummation of the contract without regard to the amount of the appraisal valuation. Okay. I'm going to stop right there because the rest is just more language. But up to that point, basically what it's stating is, if the house doesn't appraise, irregardless of what was agreed upon in the rest of the contract, it doesn't matter. The buyer does not have to make or continue with the purchase, and they can basically terminate and get their deposit money back. Okay, buyer will not be obligated to complete the purchase, notwithstanding any other provisions of this contract. So if you wrote on the last page of the contract, buyer will pay $15,000 gap coverage, and it's an FHA deal, does that even matter now, Jim?
Well, if it's not an FHA deal, this wouldn't apply. Is that what you asked, Colin?
Well,
Sorry.
if it's an FHA deal and you wrote on the last page of the contract, buyer's willing to pay $15,000 gap coverage, and it was short $15,000, does the buyer have to buy the property?
No, because it's FHA.
Yeah, and it says here, notwithstanding any other provisions of this contract, irregardless of what else was agreed upon, this sticks.
But if they wanted to, they could proceed, right? It's just that this.
Yes,
Okay.
they don't have to.
Okay.
Okay. Paragraph D has two boxes. Buyer acknowledgement. Buyer has received a HUD notice for your protection, get a home inspection. So I believe that's in zip forms you can give to the buyer, a little pamphlet that you've advised them on getting a home inspection. Okay. Probably a good idea to check mark that box. Buyer will apply for Section 203K financing, and this contract is contingent upon mortgage approval and buyer's acceptance of additional required repairs as required by the lender. Okay, so that's for 203K. Paragraph E, certification. We, the undersigned sellers and buyers party to this transaction, each certify that the terms of this contract for purchase are true to the best of our knowledge and belief, and that any other agreement entered into by any of these parties in connection with this transaction is attached to this agreement. So if you have any outside agreement, it's attached. Okay, there's no other arrangements between the buyer and seller, especially exchanging finances. And they want to know everything that's going on within the deal. So we went through, what is this, 5 paragraphs, A, B, C, D, and E. And finally, we get to F, which is the actual contingency, whether you're going to elect it or waive it. Okay, so everything before this, it doesn't matter what happens from here on out. Everything before this is just the preface, whether they elect the mortgage contingency or not. Okay. So F, mortgage contingency. So you can either waive it, and if you waive it, this sale is not contingent on mortgage financing, although buyer may obtain mortgage financing and or the parties may include an appraisal contingency. Okay. Buyer and seller understand that the waiver of this contingency does not restrict buyer's right to obtain mortgage financing for the property. So when you see that, I remember people would used to say, agents would used to say to their sellers, oh, they waived it, it's a cash deal. It's not. It's just they're waiving their mortgage contingency. They're just saying it doesn't matter what happens, I'm going to come to the table with cash, with the money. Okay. Second part is elected. This sale is contingent upon buyer obtaining mortgage financing according to the terms outlined below. Okay, outlined below. So that's the boxes. Upon receiving documentation demonstrating lender's approval, whether conditional or outright, of buyer's mortgage application, according to the following terms, buyer will promptly deliver a copy of the documentation to seller, but in any case, no later than blank. And I wrote, do not leave blank and highlight it, because so many times I see this line blank, okay? And in parentheses, it says commitment date. So what happens when you leave this blank and send it to the seller? Okay. Basically, the seller can call on that commitment letter at any time. Okay. And when they call on it and you can't give it to them, they can back out. Or they can just plain back out of it without really even giving you much notice, other than saying, hey, we didn't receive your commitment date. You didn't have a date on there, so I can call it at any time, and I didn't get it. Okay. That happened one time when I had a seller who wanted to back out. And I said, sir, you can't back out. Okay. But let me look at the contract and let me see if there was a way. Okay. And I looked through the contract, and sure enough, that date was blank. And shame on me for not catching it before we went under contract, but it kind of worked to our advantage. And I just sent the seller a termination notice that said he's backing out because he did not receive documentation, okay, a commitment letter. We did give the deposit money back to the buyer, right, because the seller's terminating. And when the buyer agent received it, he was flabbergasted. He had his broker call me, and I said, well, what do you want me to do? We called on your commitment date, which you left blank, so we can call it at any time, and I don't have a commitment letter. Well, he gave me one when he called, but that's too late. I already sent the termination. Okay. So that's the kind of stuff that can happen. Okay. So we have the boxes here from line 145 to 159. Let's go over it real quick here. First mortgage on the property. So the left side is for the first mortgage. The second side is if they have some kind of piggyback loan. Okay, second mortgage. So here we have a loan amount of blank. Fill in. Okay. Put in a number. Get it from your lender. Okay. Minimum term, blank years. Type of mortgage. Conventional, FHA, VA, USDA. Okay, fill it in. The next one is for conventional loans. Okay, so you have FHA, VA, you don't have to worry about filling this in. But for conventional loans, the loan to value ratio is not to exceed blank. So if you're putting 20% down, its loan to value is 80%. If you're putting down 5%, the loan to value is 95%. Okay. Mortgage lender. That's where you put in the name of the lender that the buyer wishes to use. Okay, and as I said earlier, several spots in this contract, it actually says if one is stated. So yes, could you leave it blank? Yes, but most list agents want the buyer to kind of be locked in already before they accept a contract. Okay. The interest rate is blank percentage. However, buyer agrees to accept the interest rate as may be committed by the mortgage lender not to exceed a maximum interest rate of blank percent. So it's asking for a range, because right now we're not locked into a rate. Okay. As soon as we get this contract back executed, then we can go shop and lock in a rate. All right. You can't lock in a rate beforehand without a contract, fully executed contract. So let's say your interest rate right now is 6.5. Put in 6.5, and then a maximum interest rate, put a spread in there. Okay. 6.75 or 7, something. Now, what I have done in the past, let's say you work with someone that their credit isn't as high, they got a pre-approval, and they're getting a rate of, let's say, 7%. Okay. Now, when you look at these contracts, especially in a multiple offer situation, and you're comparing these things, when you see interest rate that's higher than the normal, okay, if you have 5 offers and 4 of them are like 6.25 to 6.5, and then all of a sudden you have one that is 7, that's kind of a red flag, right? Maybe the credit isn't as high. So what I've done in the past is, if my client is, let's say, at that 7, I'll put in a spread of 6.5 to 7. Okay. And if the list agent isn't savvy and they don't read the pre-approval, they'll think, oh, 6.5 to 7. Okay, that's a good spread. And then just present it to their seller and think nothing of it. Okay. So that's just a little thing that I do to kind of give my buyer a little edge in that scenario. Okay. Do you understand what I did there, Emily? You're nodding your head like, oh. The next item is something you should definitely ask your lender. Okay. Discount points, comma, loan origination. Every loan has an origination charge, right? As far as I know. Comma, loan placement, and other fees charged by the lender as a percentage of the mortgage loan, excluding any mortgage insurance premiums or VA funding fee, not to exceed blank percent, 0 if not specified, of the mortgage loan. See, we've always kind of left that blank, haven't we? I mean, has anybody ever filled that in? It might be a good idea to start at least putting in something in there, and that something should come from the lender. Okay, because every lender is going to charge something, and if they charge something, then there should be some kind of percentage in there, right? So if you're selling a house that's $300,000 and you have 1% in there, that means any fees up to $3,000. The buyer still has to abide by this. Okay, so just ask your loan officers about that. Okay, just to be sure. Moving on to, it's F, paragraph F, subparagraph 1 of F. The interest rates and fees provision in paragraph 8F are satisfied if the mortgage lender gives the buyer the right to guarantee the interest rate and fees at or below the maximum level stated, okay, within the range. Buyer gives seller the right at seller's sole option and as permitted by law and the mortgage lenders to contribute financially without promise of reimbursement to buyer and or mortgage lender to make the above mortgage terms available to buyer. So let's say if the house didn't appraise and all of a sudden we have a bad loan to value, the seller can contribute by reducing the price. Okay. Or they can contribute somehow with closing cost help. Okay. Whatever the lender will allow, without promise of repayment. So I can't say, yeah, I'm going to reduce it to 20,000 or $10,000 so you can buy the house. But Mr. Buyer, later on, you're going to pay that $10,000 back. Okay. Can't do that. Okay. 2, subparagraph 2. This one's important because 8F2 is always referred to because this is where it allows the seller to back out of this deal. Okay. Seller may terminate this agreement after the commitment date, okay, after the commitment date by written notice to buyer if one of 3 things. A, or 1, seller does not receive a copy of the documentation. So after that date, the seller still hasn't received a commitment letter. They can just back out. All right. Now you see why we have to have a commitment date, because if there's no commitment date, it's kind of open-ended and the seller can pretty much do it at any time. Right. So 1, the seller can terminate if they don't get a copy of the commitment. B, or 2, the documentation demonstrating lender's conditional or outright approval of buyer's mortgage application does not satisfy the loan terms outlined in paragraph 8F. Okay. So let's say the lender sends a letter and says, well, you know, we had an appraisal shortage. We can't do this loan for whatever reason. And it's in writing, and the seller looks at it and says, well, I'm not going to reduce the price. Okay. So what can they do? They can back out of the deal. Okay. Or let's just say the documentation demonstrating lender's conditional or outright approval of buyer's mortgage application does not satisfy the loan terms outlined in paragraph 8F. Okay, so we're still on 2 here. What if in that box you have down that the type of mortgage is conventional and you get this commitment letter and now it's FHA? Right? Would that fall under this number 2? Tim?
Sorry, I'm trying to unmute myself. Say that.
I was just saying this paragraph 2B here, number 167. It says the documentation demonstrating lender's conditional or outright approval of buyer's mortgage application does not satisfy the loan terms outlined in paragraph 8F. So I was saying, if you wrote in here that the type of mortgage you're getting is conventional, and then you get this commitment letter and it says, congratulations, buyers approved for FHA.
You have the right to get out of the deal.
The seller does.
If you had it in there at 80% and it doesn't appraise, and now, you know, or, you know, for instance, if it changes your financing terms,
Right.
that instead of 10% down, now you got to go 5% down, you can also get out of the deal.
Right. Exactly. That's our soft appraisal contingency. And by soft, see, when you have a mortgage contingency, or I'm sorry, an appraisal contingency, and you elect option 1 and it didn't appraise, the buyer can just write a termination and back out, right? The buyer can't. In this case, if you have an appraisal shortage, okay, it's up to the seller then to say, okay, yeah, I'll reduce the price to sell it, or, oh, I'm not reducing the price, I'm terminating this deal. That's their option, the seller's option, not the buyer's. Okay, so the buyer can't just say, wow, I kind of want out of this deal now, I'll use this option here, the mortgage contingency. Can't do that. Okay, They can only get out of it if the seller terminates it and allows them out of the deal. Okay, keep that in mind. Where are we at? 2C. Emily, you understood that whole 2B though? You good? Okay. The documentation, 2C, the documentation demonstrating lender's conditional or outright approval of buyer's mortgage application contains any condition not specified in this agreement. Here's some examples they give. Buyer must settle on another property, comma, an appraisal must be received by the lender, comma, or the approval is not valid through the settlement date. That is not satisfied and or removed in writing by the mortgage lender within 7 days after the commitment date or any extension thereof, other than those conditions that are customarily satisfied at or near settlement. Examples: obtaining insurance, confirming employment. So this is stating that if the commitment letter all of a sudden says, yeah, this buyer has to sell their house. Well, wait a minute, we didn't agree on that. We don't have a sale and settlement contingency on this deal. I didn't even know the buyer had a house to sell. Okay. That's what they're talking about. All of a sudden, a condition popped up that the seller wasn't aware of. Okay. We've seen some weird conditions come up. We've had some where the buyer had to pay off a car loan. You know, that's happened. Or let's say the buyer had to pay child support. They're in arrears. Okay. That's what that's talking about, the unknown stuff that came up. 3, seller's right to terminate. So the seller can terminate, continues until buyer delivers documentation demonstrating lender's conditional or outright approval, the commitment letter. Okay. Until seller terminates this agreement pursuant to this paragraph, buyer must continue to make a good faith effort to obtain mortgage financing. So they can't just stop and freeze. They got to continue with the deal. Okay. Termination of this agreement by buyer due to the mortgage lender's denial of buyer's mortgage application may demonstrate bad faith by buyer and the result in the forfeiture of deposit monies to the seller. So right there, it states, if the buyer terminates, that's demonstrating bad faith by the buyer and they may lose their deposit money. That's plain English right there. That's what that's stating. So again, it's not the buyer's right to terminate. Okay. So let's say we had a commitment date of April 1st. And today's April 5th, and we still haven't received that commitment letter, right? The seller can still terminate at any time. I don't know why they wouldn't do it on April 2nd, okay? But the buyer, in the meantime, they still have to continue with the deal. So if there's an appraisal scheduled for April 3rd, they can't just say, oh no, the seller's probably going to cancel this deal, so I'm going to cancel this appraisal on April 3rd. Can't do that. They have to make a good faith effort to continue. Okay. A question arose last time by another agent in our office after the meeting, and the comment was, let's say you have as the mortgage lender up here in this box, right? Mortgage lender, let's just say is Wells Fargo, and they denied you. Does the buyer have to make a good faith effort and try to get mortgage with another lender? Any thoughts on that? Okay. I did call the hotline on that one, and they said that no, not necessarily, Because if you got denied and you wrote in here that you're getting a loan with Wells Fargo and they denied you, you've made a good faith effort to try to get a loan through whatever was filled into this box. Okay, even if it was blank and you went with a mortgage lender and they denied you and you showed it to the seller, you made a good faith effort to get the loan. It's just you can't. It doesn't say you have to keep trying with different companies to do so. Okay. All right, so 3 talks about the seller's right to terminate and the fact that the buyer still has to make a good faith effort and they can't just terminate. Okay. 4, if this agreement is terminated pursuant to paragraphs 8F2. Okay, so let me rephrase this. If this agreement is terminated by the seller, okay, because paragraph 8F2 allows the seller to terminate. So if this agreement is terminated because of the seller, or the loan, the mortgage loan is not obtained for settlement. So we come to settlement, we're sitting there and there's no money, right? No money, no house. Is not obtained for settlement, all deposit monies will be returned to buyer according to the terms of paragraph 26. And this agreement will be void. Okay, once the settlement date has passed, it's void. Buyer will be responsible for any costs incurred by buyer, okay, for any inspections or certifications obtained according to the terms of this agreement, and any costs incurred by buyer for title search, title insurance, liens, or any cancellation fee, flood insurance, fire insurance, hazard insurance, or any fee for cancellation, and 3, appraisal fees. So the buyer will lose on all those fees, okay, but they get their deposit money back. So if number 4 again, if the seller terminates or the mortgage loan is not obtained for settlement, all deposit monies will be returned to buyer. That's where the contingency for the buyer kicks in. Okay. Everybody got that? Five, if the mortgage lender or a property and casualty insurer providing insurance required by a mortgage lender requires repair to the property, buyer will, upon receiving the requirements, deliver a copy of the requirements to seller within blank days, 5, okay, of receiving the copy of the requirements. Seller will notify buyer whether seller will make the required repairs at seller's expense. Okay. So let's say we have an FHA deal. The lender says we need handrails. Okay, handrails and chip paint, those 2, right? So A, if the seller makes the required repairs to the satisfaction of the mortgage lender and or insurer, buyer accepts the property. Okay. Notice how it says, if the seller makes the repairs to the satisfaction of the mortgage lender. It doesn't say to the satisfaction of the buyer. Okay, so the buyer can't just say, well, I wanted a wrought iron railing. and they just put up cheap vinyl. But the lender okayed it, right? So it's to the satisfaction of the mortgage lender and or insurer. B, if seller will not make the required repairs, or if seller fails to respond within the stated time, buyer will within 5 days notify seller of buyer's choice to 1, make the repairs themselves, or 2, terminate this agreement. Okay, so there's where the buyer can terminate if the seller doesn't respond or the seller does not want to make the repair. If buyer fails to respond within the time stated above or fails to terminate this agreement by written notice to seller within that time, buyer will accept the property, make the required repairs, improvements at buyer's expense, and agree to the release. So if the buyer doesn't respond either, then you're responsible for it, Mr. Buyer. Okay. There you go. That's the mortgage contingency.